Imagine walking into a fancy restaurant, ordering your favorite meal, and when the check comes, it is way higher than you expected. That sinking feeling is exactly how many people feel when they see the bill for financial advisory fees. But here is the question. Are these fees really worth it? Or are you just paying for an expensive dinner you did not need? Stick around, because by the end of this video, you will know whether financial advisors are a smart investment for your money or an unnecessary drain on your wealth. And there is a surprising twist most beginners never think about that could change how you see this forever. Number 1. What are financial advisory fees really? Let's start simple. Financial advisory fees are what you pay someone to manage your money or give you financial advice. This can be a flat fee, a percentage of the money they manage for you, or even an hourly rate. For example, if you have $100,000 invested and your advisor charges 1%, you will pay $1,000 every single year just for their service. Some advisors charge more, some less. But the truth is, these fees add up fast. Now here is the curiosity loop. If the fees take away from your wealth, why do so many wealthy people still pay them? Hold that thought. We will uncover the answer in just a moment. Number 2. Different ways advisors charge you. Advisors do not all use the same pricing model. Some charge based on assets under management, often called AUM. This is usually between 0.5% to 1% of the assets they handle. Others may charge hourly, like $200 an hour. Or they might charge a flat annual fee, like $3,000 a year. There are even commission-based advisors who make money when you buy certain products, like insurance or mutual funds. That sounds harmless until you realize they may recommend things that pay them more, not necessarily what is best for you. Imagine paying a mechanic who only gets paid if they sell you more car parts. Would you fully trust their advice? That is the same risk with commission-based advisors. Number 3. The hidden cost of fees over time. Here is where it gets tricky. 1% may not sound like a lot, but over time, fees can eat away at your money like termites in a wooden house. Let's say you invest $100,000. If it grows at 7% a year for 30 years, without fees, you end up with about $761,000. With a 1% fee every year, you only have around $574,000. That is nearly $187,000 gone. That missing money did not disappear into thin air. It went to the advisor. This is why understanding fees is so important, because what looks small today can cost you your dream retirement tomorrow. Number 4. What do you actually get for paying these fees? Now you might be asking, if fees cost me so much, why do people still pay them? Good question. Advisors often do more than just pick investments. They create financial plans, help with retirement strategies, minimize your taxes, and make sure you do not panic when the stock market drops. For example, during the 2008 financial crisis, many investors sold their stocks in fear and lost big. Advisors who guided clients to stay calm helped them avoid devastating mistakes. That kind of emotional support alone can sometimes be worth the fee. Think of it like hiring a personal trainer. You could technically go to the gym alone, but having someone guide you can keep you on track and save you from injuries. Number 5. When financial advisors add real value. Not everyone needs a financial advisor, but here are times when they can be a lifesaver. If you have a complicated financial situation, like running a business, owning multiple properties, or receiving a large inheritance, advisors can help you navigate the complexity. They can also add value by helping you reduce taxes legally. For instance, a skilled advisor might save you tens of thousands of dollars by recommending the right retirement accounts or investment strategies. Or maybe you just do not have the time, knowledge, or discipline to handle your finances. An advisor can take that burden off your shoulders. Number 6. When financial advisors might not be worth it. Here is the other side of the coin. If you are just starting out with a few $1,000s, paying a 1% fee might be overkill. You could actually lose more to fees than you gain in returns. For example, if you invest $5,000 and pay a 1% fee, that is only $50 a year. But if the advisor puts you in expensive mutual funds with extra fees, you could easily be losing hundreds more every year without realizing it. In that case, you might be better off starting with a simple index fund through a low-cost platform like Vanguard or Fidelity. Number 7. The rise of robo-advisors. Technology has changed the game. Robo-advisors are automated platforms that manage your investments for a fraction of the cost. Instead of charging 1%, they may charge only 0.25%. That means if you have $100,000 invested, you would pay just $250 instead of $1,000. They are not perfect. Robo-advisors cannot talk you through a financial crisis or help you plan your estate. But for beginners with simpler needs, they can be a cost-effective way to start investing without draining your wallet. Number 8. How to know if your advisor is worth the fee. Here is the million-dollar question. How do you know if an advisor is worth paying? Start by asking them to explain clearly how they are paid. If they dodge the question, that is a red flag. Next, ask what value they bring beyond investments. Do they help you with taxes, budgeting, or estate planning? Do they teach you along the way so you become smarter with money? Finally, compare the cost to the benefits. If you are paying $5,000 a year in fees, but they save you $10,000 in taxes, that is worth it. If all they do is put you in mutual funds you could have bought yourself, then you might as well keep your money. Number 9. The psychological benefit no one talks about. Here is something beginners often overlook. Managing money is emotional. It is not just numbers on a page. Fear, greed, stress, even excitement can lead people to make bad decisions. An advisor acts like a financial therapist, keeping you from making choices you will regret. Think of it like flying on a plane. You could technically learn how to fly yourself, but sometimes it is better to have a trained pilot in the cockpit so you can relax. This peace of mind is part of what you are paying for. And for many, that is priceless. Number 10. How to lower your fees without losing help. Here is the good news. You do not always have to choose between paying high fees and going solo. Some advisors offer hourly consultations, so you only pay for what you need. Others may provide flat-fee financial planning, which can be cheaper than paying a percentage. You can also use a hybrid approach. For example, use a robo-advisor for your investments, but hire a human advisor once a year to review your overall plan. This way, you get guidance without overpaying. Number 11. The difference between fiduciary and non-fiduciary advisors. Not all advisors are held to the same standard. A fiduciary advisor is legally required to put your interests first, even if it means they make less money. A non-fiduciary advisor, on the other hand, only has to recommend something that is considered suitable, which leaves more room for conflicts of interest. For example, a fiduciary advisor might suggest a low-cost index fund because it is the best choice for you, while a non-fiduciary might push a fund with higher fees because it earns them a commission. Knowing this difference can save you thousands of dollars over time. Number 12. The opportunity cost of paying fees. Every dollar you pay in fees is a dollar that could have been invested and grown. If you pay $2,000 a year in fees and instead invested that money at a 7% return, after 20 years you would have about $82,000. That is money you miss out on when fees are too high. So the real cost of fees is not just the money leaving your account, but also the lost growth it could have earned for you. Number 13. Advisors can protect you from costly mistakes. Even if fees feel painful, one avoided mistake can sometimes cover years of payments. For example, selling your investments in a panic during a market crash could cost you tens of thousands of dollars in lost growth. An advisor who convinces you to stay the course during those stressful times can protect your long-term wealth. This kind of mistake prevention is something many beginners underestimate until they experience it firsthand. Number 14. Advisors can connect you to opportunities. Sometimes the value of an advisor is not just what they know, but who they know. Advisors often have access to exclusive investments, professional networks, or tax strategies that you might not discover on your own. For example, some high-net-worth advisors can give clients access to private real estate funds or pre-IPO opportunities. While not every beginner needs that, it shows how advisors can open doors that may otherwise stay closed. Number 15. Advisors as accountability partners. Think about how many times you promised yourself you would start saving or investing, but life got in the way. An advisor can act as your accountability partner, reminding you of your goals and making sure you follow through. Just like a coach who pushes athletes to train harder, an advisor can keep you disciplined in your financial journey. Sometimes, that accountability is the difference between reaching your goals or staying stuck. At the end of the day, Financial advisory fees are like gym memberships. Some people sign up, never go, and waste money. Others use them to transform their lives. The difference is not in the fee itself, but in how much value you actually get back. So here is the question for you. Do you think financial advisory fees are worth paying? Or do you believe you can manage your money on your own? I would love to hear your thoughts in the comments.